ever since COVID hit the UK and her government ordered a nationwide lockdown to help prevent the widespread of the disease, the UK economy has experienced some major crises or changes if we decide to be lenient. Even now, when the economy is attempting to recover, it is faced with stumbling blocks resulting from high cost of living, increased inflation, and a drastic rise in energy prices. Now, the question everyone is grappling with is, could the UK be facing down the barrel of her worst ever economic meltdown? Early April this year, the UK economy experienced its fastest meltdown in the last 12 months because of the government's decision to draw gradually to a close the COVID testing, saying that risk of a wider spread of the disease is already on its way. It is believed that the initial wave of COVID-19 and late entry into a tight lockdown caused a big freeze in activity across the country, causing the worst recession in 100 years. We can see from statistics how the COVID outbreak has affected the UK economy beginning from 2020. In the beginning, during the first national lockdown, sales in the United Kingdom decreased by 22% from February to April 2020. As the economy reopened, there was a particularly big rebound, with a 13% monthly gain in May 2020, followed by a further 14% increase in June. Sales increased at a slower rate in the months leading up to October 2020. When we talk about the November 2020 lockdown, we see how it resulted in a 4.7% monthly drop in sales volumes. December saw a slight plus 0.6% resurgence as the lockdown limitations were temporarily put on hold. The UK's GDP fell over 20% in the second quarter of 2020 and by 9.4% overall for this year, making it the lowest result in the group of 7 countries, or G7 simply put. But unofficial estimates show that GDP fell by 9.7% in 2020, making it, even at that rate, the sharpest reduction since consistent records began in 1948 and equal to the dip in 1921. During the first lockdown, the UK GDP in April 2020 was 25% lower than it was only 2 months earlier in February. In March 2020, the coronavirus' first significant effects on the UK economy became clear. In the course of the months, COVID-19 spread quickly. In response, social distancing measures were implemented before the Prime Minister on March 23, 2021, announced a complete national lockdown. Now, the effect of this early 2021 lockdown was that it resulted in a 7.9% monthly drop in retail sales volumes in January. The month of February saw a small increase of 2%, followed by higher improvements in March and notably April, when restrictions were put on hold and non-essential retailers reopened in the UK on April 12. COVID is said to have affected the UK's economy even in terms of sales. Retail sales declined for 5 consecutive months from September 2021 to September 2022 before rising. Retail sales volumes in November 2021 were 7.2% higher than in February 2020 before the coronavirus. This overall figure does not completely show some significant diversity among different types of retailers. Food stores in general have experienced a fair increase, and DIY businesses did well in the early reopening period. But clothing store sales initially suffered before recovering. Speaking of UK's GDP and how it was affected by the COVID outbreak, Office for National Statistics, ONS, reports that the economy's gross domestic product fell by 0.3% in March of 2021. At the same time, output fell by 0.1%. These figures do not put the UK economy in a good light, as this meant that the UK's manufacturing, services, and construction were steadily going down, and this was all happening for the first time. Yael Selflin, the chief economist at KPMG UK, said that the fall in output was unlikely to be short-lived. His reason was that the overall outlook remained downbeat as the squeeze on consumer income was expected to weaken demand. Bloomberg Economics predicted the momentum to remain the same in the following months, with output to decline by a marked 0.4% in the second quarter as the real income squeeze began to unfold. When the pound fell, it fell by 0.6% to $1.2238, which was its lowest in a single month. Nearing the second week of June this year, investors started predicting by placing a bet that the Bank of England would announce a half-point rate increase. It was later seen from the GDP report that services dropped to a 5.6% decline in health spending. In April, test and trace activity fell to about 70%. The Office for National Statistics, ONS, said the economy would have grown by 0.1% if not for the test and trace vaccines in that same month. All these are facts based on GDP reports. If these are some of the known effects COVID has had on UK's economy in general, how do we know the boomerang effect it has caused on the day-to-day consumer? Is it not appropriate at this point to ask how COVID affected consumers personally? Thing is, the first nationwide lockdown resulted in a number of companies closing based on imposed voluntary movement restrictions, which combined to reduce consumer spending opportunities. During this time, consumer spending drastically reduced. It lessened by a 20.3% decline in the second quarter, April to June 2020, compared to the first quarter of 2020. In the first quarter, consumer expenditure had already fallen by 2.6%. Obviously, the act of spending less on hospitality, transportation, and leisure activities was the major cause of this reduction. This was a tough time for households in April, when energy bills skyrocketed by 54%. That jump was but unseen and unexpected. The payroll taxes also skyrocketed in the same month. Because of this, sadly, households were forced to cut down on non-essential items as the cost of living became increasingly high. Yet households did not suffer alone. Manufacturing was reported to have fallen by 1%, which when looked at doesn't seem to be much. Yet businesses suffered the impact of price increases and supply shortages, so it made sense that construction fell by 0.4%. Based on report, business investments were predicted to increase by 11% in 2022 after an 11% drop in 2020 and near stagnation in 2021. Housing investment recovered more quickly and is forecast to grow just 3.5% in 2022. With house prices rising at a similar rate before growth slows from 2023. The current account deficit, which shrank when the pandemic hit, is expected to widen above 3% this year and close to 4% from 2023. Inflation will also remove the value of the mild fiscal loosening announced at the spending review in October 2021, to the extent that an upward revision of department spending plans ahead of the general election is considered an upside risk to the central case scenario in the UK's fiscal forecast. In UK's main case scenario of no increase to nominal department budgets, real government consumption will be squeezed with an average real terms increase over the coming years of 2.1% per year rather than the 3.3% that was planned in October. GDP is estimated to have been 7.3% higher in 2021 than 2020, a slightly larger rise than in UK's autumn economic outlook, partly thanks to the data revisions by the Office for National Statistics. As we've seen that household and government consumption both rose strongly while investment by the housing and government sectors grew by 14% and 11% respectively, but business investment was close to stagnation at 0.5%. On the latest measures of monthly GDP, services and construction output exceeded their pre-COVID levels by November 2021, with the largest contribution from the health and social care sector, though production remained 2.6% below its peak. In the case of potential GDP, this is driven by an annual labor productivity growth rate expected to be around 0.5% following the signing of the Trade and Cooperation Agreement with the European Union. April was the third month, according to GDP reports, that the UK economy did not grow, which was a clear sign that the economy was weakening rapidly in the face of inflationary pressures. This report will not be complete without emphasizing on how after COVID, unemployment in the UK peaked. In a more recent finding, the unemployment rate in the United Kingdom has risen to 3.6%, although it remains close to the lowest level in almost half a century, according to official figures released lately. The unemployment rate rose to 3.5% in the 3 months to the end of September, from 3.5% at the end of August, according to the Office for National Statistics. It was about the lowest level since 1974 at 3.6%. At the same time, excessive inflation continues to compress wages, bringing about widespread strike action across the United Kingdom. Darren Morgan, Director of Labor and Economic Statistics at the ONS, said that 500,000 days were lost to strikes in August and September, which were the highest 2 months in more than a decade, with the vast majority coming from the transport and communication sectors. Darren made a remark that with the earnings continuing to fall, it was not surprising that employers that they surveyed said that most of the disputes that occurred were about pay. Annual inflation in the United Kingdom has now risen to more than 10%, the highest level in 4 decades, and is expected to rise further as energy costs and food prices rise. So if you, at this point, ask whether or not UK's economy has seen its worst, I think the answer is anyone's guess. I mean, consumers and companies are expected to take another blow in a government budget that includes tax increases as Finance Minister James Hunt strives to shore up the state's weak coffers on Thursday. Hunt says in reaction to the unemployment data, as he prepares also to announce this week's cuts to state departmental budgets, that tackling inflation is his absolute priority, and that guides the difficult decisions on tax and spending that will be made on Thursday. He also said restoring stability and getting debt falling is UK's only option to reduce inflation and limit interest rate rises. Anyhow, the UK's GDP has already been predicted to rise by 4.8% in 2022 and 1.3% in 2023. Consumption and investment are likewise predicted to expand at comparable rates year on year. Interest rates are now predicted to grow faster, with 4 increases expected in 2022 and the bank rate hitting 1.5% by the third quarter of 2023. Here is the hope too, that despite rising interest rates, consumer price inflation is expected to average 5.9% in 2022, down from a peak of 7% in the second quarter to 4.7% by the end of the year. Yes, the year is nearing its end, and the UK's economy is said to have seen its worst. Still, no one can really tell the progression of the economy going forward. There is only the hope that things will begin to get better from now on.